Good afternoon once again, and thank you for joining us today for our webinar on Business Valuations 101. My name is Mary, and I'll be your moderator today. If you have any questions throughout the webinar, feel free to message in the chat box. You can do so by clicking on the chat icon at the bottom of your screen, which will then open the chat box. If you have any technical difficulties throughout the session, feel free to message me by clicking on the drop-down menu and selecting All Panelists, or by raising your hand by clicking the Raise Hand icon on your screen. We will open the floor to questions at the end of the presentation, but we encourage you to ask questions as we go along. You can ask a question in the chat box. If your presentation screen happens to be too small, you can enlarge it by clicking on the line and dragging it to the right. It will then look like this. Today, our presenters are Omar Chowdhury and Michael Nazarovich from RLB. I'll pass it over to them. So good afternoon, gentlemen.
Hi, Mary. Thank you. Hi, everyone, and welcome to Business Valuations 101 at RLB. I'll start off by giving you guys a bit of background on us. Then I'll share some different situations in which you may need a valuation. We promised you guys that we would answer 3 questions in this webinar. So Michael will talk about the different ways in which we figure out the value of a business. I will share with you how COVID-19 has impacted the values of businesses. And as financial experts, we don't just value businesses, we do a lot of other things, and Michael will talk about that. And one of the things that we do is quantify losses for victims of fraud. So we will share with you our experience on how things turn out for the victims. Before I jump into it, I wanted to take a quick poll to see who our audience is today. I skipped over this slide. Here we go. So Mary, if you could put up the poll. So I think you guys will be able to it'll pop up on your screen and you should be able to just select with your mouse the answer. And I'll let Mary put up I'll give you guys maybe 30 seconds or something. And then once the results are in, there we go, it's popped up. And then once everybody's had a chance to vote, then it'll show kind of who our audience is today. All right. So it looks like we have a lot of business owners / investors, and then we also have some accountants and some lawyers. Okay. So I'll try to gear our discussion towards that, especially to business owners. So if you're not already familiar with RLB, let me just move the slide forward. There we go. If you're not already familiar with RLB, very quickly, we've been a public accounting firm in Wellington County since 1951. We currently have offices in Guelph, Kitchener, Fergus, and Orangeville. The RLB team is made up of 11 partners and about 150 full-time staff. We have some niches that we specialize in. These are areas of expertise that are kind of our bread and butter. We have dedicated teams who work and who are very experienced with these. So agriculture, obviously being in Guelph, condominiums, construction, professional service firms, and not-for-profits as well. We also have a large clientele of engineering firms and insurance brokerages, so we're experienced in those industries as well. So that's RLB, and inside RLB, we are a valuations team. So we're led by our partner, Jason Gibbons, and myself and Michael are 2 managers, and then we have various staff assisting us. Within our business valuation expertise, we have our own special industries that requires special knowledge that we can share. For example, construction, engineering firms, insurance brokerages, supply managed agriculture, real estate investment trusts. We have a lot of experience in these specific industries in terms of valuations. Now I'd like to talk about the different situations in which you may end up needing a business valuation. So in my experience, all the work we do is as a result of one of these 3 triggers. Either somebody is buying or selling a business, or there's a disagreement or dispute that's creating that is requiring our services, or there's a government requirement that needs to be satisfied. I'll give you some examples. So for example, you're buying into a business interest. You want to make sure you're not overpaying, or you want to know if you're getting a good deal. If you're selling your business, you want to make sure you don't accept a lowball offer. You want to, maybe you want to set an asking price, so valuation can help with that. So these are, needs created from transactions. Then on the conflict side or the dispute side, there's family law matters. Obviously, if there's a separation or divorce, and if one of the spouses owns a business interest, then that needs to be valued, and courts will want a financial expert to figure out the value for that. Loss quantification, if there's been some kind of a theft or fraud or some kind of contractual violation, figuring out what that's worth, what the dollar impact is. And then on the government side, estate planning. So, you might be doing planning, you want to transition the business to the next generation in the most tax effective way, trying to take advantage of some, provisions in the tax code. CRA wants to make sure that you properly value your business when you're doing that, because that can really affect the amount of tax benefit you get. And so they're very critical of that. And to support that, you need a business valuation. And then, listed entities, investments that that are publicly traded or not-for-profits, those types of businesses also, those types of entities also have to do financial reporting, and for that they need to figure out how to value certain intangible assets and other things, and that's where we come in as well. And now I will hand it over to Michael.
Morning, everyone. Thank you, Omar. Just due to some technical issues I'm having with the webcam, so I'll just be showing my lovely display picture this morning. I wanted to go through some of the ways that businesses are valued. So when we're valuing a business, we're calculating what's called a notional value. So since we're not actually putting the business up for sale, we won't know for sure what the business will fetch on the open market. So in a sales scenario, the price for a business will depend on things like how knowledgeable the buyer is of the specific business or industry, the negotiating abilities of either side, and things that affect the timing of the payment of the purchase price. So things like earnouts or vendor take-back financing when you're receiving the payment over a period of time. So depending on the type of business, we'll utilize three main approaches to valuing the company. So for holding companies that own real estate, investments, agricultural quota, the value is mostly tied to the assets of the business. Typically, financial statements only show the value of the business or the value of the assets in terms of cost or amortized cost. So this doesn't really tell you what the business is worth just by looking at the financial statements. So what we typically do is we take a look at all the assets the business has and then either mark them up or down to market value, and then subtract any taxes that would be associated with that. In an active business where the value is associated with cash flows, we use an income-based approach. So with this approach, we look at either the historical or projected earnings, and then we apply either a multiple or a discount rate to those cash flows to come up with the value of the business. So this approach can yield value over and above the value of the business's tangible assets, and this is called goodwill. If the business is expected to continue as is and as it has in the past, then we'll just look at historical earnings. But if the business is expected to change in the future or grow or decline, if there's an expansion planned, then we'll focus on projections and forecasts or budgets. In terms of a multiple, some of the things that we consider when we're looking at a multiple for a specific company or discount rate is the current economic environment, both nationally and locally. In any industry developments or changes, and of course the financial health of the specific company. So things like cash on hand, levels of debt, and experience of management. We'll also use a market approach to check the results of our valuation against sales of similar businesses. So in this approach, we compare metrics like earnings multiples, sales multiples, and margins to other similar businesses. And basically, we use this as a secondary approach to double check the reasonableness of our valuation conclusions. So there are a number of things that can impact the value of a business. Some of these things are internal and management can control them. Other things are going to be external. So things like government and the economy as a whole. So some external factors that help business values are things like if the industry is growing, if it's a hard business to get into due to things like specialized knowledge being required or skills, or if you just need a lot of cash to actually start the business. On the other side, if the demand for the industry is flat or shrinking, if the business is relatively easy to start, so competitors can pop up whenever, or if the general economy is weak, these things can have a downward effect on the value. On the internal side of things, if a company has a history of strong, consistent gross margins, stable revenue, growing revenue, good levels of working capital, well-trained staff, all of these things can help increase the value of a company. On the other side of things, if your company is seeing declining sales year over year, poor financial records, or not really consistent financial records, if there's no succession plan for the owner, so if all the relationships are tied up with the owner, or if there's low levels of working capital, these things will have a downward effect on the value. And now Omar will take us through the impact that COVID-19 has had on business valuations.
I'll start off by asking a question from the audience, and you guys can type in the chat, and we'll see. Mary will have a look and see, and she'll kind of share with us what the answers are. So, what industry or sector do you guys think has fared the worst in 2020? I mean, we've all been watching the news and we have an idea, but I wanted to know, in your experience, what have you personally seen that has suffered the worst in this year, given everything that's happened with the COVID? I can see hospitality, absolutely. Yeah, performance-based entertainment, yes, absolutely. Restaurants. Yeah, personal service industries. Yeah, this really kind of takes us into travel, absolutely. And you can sort of see the common theme. Commercial real estate, yes. So with a lot of work from home and a lot of white collar workforce shifting to working from home and remote work, there's been we've been talking to real estate agents about how commercial real estate's going, and people are they're saying there's going to be changes in the industry, not so much of a downfall, but more of a shifting on how people use space. But that's definitely been one. All right, so this kind of takes us into what I wanted to share. And we have 3 key observations about what's happened to the values of businesses this year. The first thing is timing. There's uncertainty in the marketplace with COVID and also with the US election generally, which kind of is a little further away from us, but it does have an impact. And as a result, there's a lot of changes to public policy and the environment. Every couple of months, there's a major announcement. So businesses are operating in a continuously changing environment. And that makes the timing critical. So the value of a business today may not be the same that it will be in 2 months. And some buyers out there are aware of this. So they are trying to find the right time to buy a business. And so sellers, business owners should also be aware of that, finding the right time to sell. So it is changing. The other thing is it's sector specific. So there's the big kind of takeaway here is we haven't seen like overall business values depress or seen, what we are seeing is that it's very different. It's case by case. So some industries that exactly like the responses we got from the audience that require in-person, face-to-face interaction, that are more on the leisure side or the optional discretionary side, they have suffered the worst. And then you've got industries that were more on the forefront of technology or were already kind of going the way of e-commerce or remote work or remote technologies. Those ones it's basically accelerated their industries and they have actually boomed. So we've seen some businesses benefit, we've seen some businesses suffer, and a lot of businesses have not changed that much. So there's a big kind of group in the center that hasn't been impacted that much. So there's no blanket rule that you can apply to everything. You really have to look at everything case by case. One thing that we found is that even if because with our clients, some of them, they really have not been impacted, and it's their suppliers are steady, their customers are steady, their business model is steady, cash flows are steady, the risks haven't changed, but there are fewer buyers out in the market that are willing to buy a business in this environment. They're less willing to invest in this uncertain time. And even if they are, the banks aren't necessarily willing to lend to finance acquisitions of small businesses. So by virtue of having a smaller pool of buyers, it kind of artificially brings the value down. Like your business could be completely unchanged and just as good and safe, but if there's less people to kind of fight over and try to outbid each other, that might depress the value. So that's not happening everywhere, but in some industries, we have seen that. So when we value businesses, how do we take all this into account? The value of a business is really driven by two main items. Number one is cash flows, and number two is the risks associated with those expected cash flows. So cash flows are usually easy, but this year that's not the case. Like I mentioned before, there's a lot of new developments every few months. Some new development happens, or you're waiting on some announcement in a month from now, and you don't know if it's going to go this way or that way. And then 3 months later, you're expecting another announcement, and that could again change what the future holds. So the best way to capture all this is a multi-scenario approach, where you try to forecast 3 or 4 realistic, outcomes, and then you value those, and then you take a weighted average. And obviously, it's more work, but if you want a reliable result, that's a more reliable approach. And then on the risk side, there's the consensus amongst the evaluators seems to be that there's no, like I mentioned before, there's no rule of thumb that applies to everything. It's really case by case. Even two businesses in the same industry could be very different based on who their customer bases are, and how they're impacted by 2020. In the background, we do have a general concern, some evaluators, that maybe what's the state of the economy going to be in 2 to 5 years from now? Is that going to affect things are kind of running a certain way right now, but what does the future hold? But based on the prices that we're seeing right now in terms of businesses transacting, that risk doesn't seem to be reflected in those prices. So I wanted to put up another poll now to kind of gauge what you guys think. So when do you think that the most hard-hit industries will return to normal levels? And Mary, if you can throw that up there in terms of time frame. I'll give you guys 30, 40 seconds to fill that in. Okay, so a lot of people are thinking 2 to 3 years, which is, when it first started, we were thinking it was going to be a matter of months, but obviously it keeps getting longer. But 2 to 3 years, that seems to be the consensus. And then some people are thinking even 5 to 10 years. Okay, thank you, Mary. All right, so as we try to, take that into account in our valuation of businesses, here we look at some new things that we didn't previously look at. So we'd want to ideally look at the whole supply chain, not just the business itself, because even if your business model is strong, if one of your key suppliers is in trouble or one of your key customers, then that could have an impact on you. So, we have to kind of go that far out. Also, do you qualify for any kind of, maybe government assistance or other emergency assistance? Because that can help reduce the risk of some of dangers. And maybe you're already you're already getting some kind of assistance. How reliant are you on that? So these are things that we have to look at. Also, when management prepares budgets and projections, we want to make sure that they're reflecting the latest information that's available to them, and we might have to ask them to make revisions. And I wanted to ask you guys, at the start of this COVID section, I was talking about the hard hit industries. I wanted to ask you guys, what new industries have you seen emerge in 2020? So you guys can type your answers in the chat and we will see it. Because on the other side of it, there's been a lot of new surprising and some not so surprising industries that have popped up. I'll give you guys about 30 seconds or so. Okay. Yeah, so we've got cleaning services. Absolutely, it's even has its own name. It's called COVID cleaning. So it's relatively low skill work, and it's a great opportunity for people to our office itself. We get people to come in twice a day and wipe up all the surfaces. So the existing industry hasn't really it's been there's more demand, so that's been popping up a lot. A lot of people have been doing that, starting businesses just sanitizing and cleaning. We have virtual school education. Yep. So obviously, with a lot of people opting to either homeschool or to keep their kids at home and electronically, remotely be schooled, there's new software, there's new content material, and masks, PPE, medical equipment. Obviously, it's like it's a given now. As we go into stores, we see that stuff there, and it's like a whole new industry that has to pop up. Delivery is huge. Delivery services, be it for food or ordering any kind of other items, it's not necessarily a new industry, but it's expanded tremendously. Shipping, yeah, and Zoom. That's correct. Yeah, virtual tours. Yes, exactly. We saw the real estate, their association was asking to maybe put limits on open houses and things like that. So virtual tours, or for, those are gonna pop up. Okay. So now I'll hand it over to Michael to talk about the other things that we had. Well, valuations
Sure.
on other things.
Thanks, Omar. So there are three types of valuation reports that we issue. These are called calculation, estimate, and comprehensive. And as the name suggests, each type of report provides a different level of detail, with a calculation being relatively brief and a comprehensive report being quite a bit more detailed. In terms of assurance, we would spend quite a bit more time vetting information in an estimate or comprehensive report. Calculations are generally the fastest to prepare and least expensive option, and they're usually appropriate for a wide variety of situations. However, we will caution you that you wouldn't likely want a calculation report if you were buying a business due to the low level of assurance. We're not doing a lot of due diligence procedures in a calculation, so that would be probably the one major case where it's not super sufficient. In addition to valuation reports, we provide a number of additional services, including due diligence services, as I mentioned, loss quantification reports, financial forecasting, as well as income reports in accordance with the federal child support guidelines for family law situations. So in this table, we've outlined the cost of some of the recent reports that we've prepared, as well as some of the typical turnaround times. So this isn't necessarily a hard and fast quoting system, but it gives you kind of an idea of what some of the ranges are. Of course, this will vary depending on the individual circumstances that we're working with. So in terms of the typical process that we go through when we prepare a valuation or any engagement, we usually start with an email or a phone call just to get a sense of what you need, what needs to be done, and then we can discuss and prepare a quote for you. And then we'll send an engagement letter out and a document list. So normally we'll request things like financial statements, tax returns, and any appraisals that you would have for equipment or real estate. And then we'll prepare the valuation model, do our analysis, and then send out drafts for feedback and then finalize the report. Usually this process typically takes around 4 to 6 weeks from the time that we receive all the initial necessary information. Of course, this is, the timeline that we're discussing. It can vary quite a bit depending on the time of year and the level of engagements that we have on the go. So in terms of non-valuation services, we also offer a number of services beyond the scope of just traditional valuations, including specific reports to assist with buyers and sellers of businesses. So one report that we prepare is called a quality of earnings report, and that discusses the sustainability of a business's earnings. We can also prepare a payback analysis, which shows the whether or not a business can sustain a specific loan payment over time and repay its loan to the bank. This is particularly useful for banks to assess whether or not the business is, if they can finance it. We also host virtual data rooms so that in the due diligence procedures, you can share confidential documents securely, as well as provide any general assistance with things like letters of intent, negotiating purchase and sale agreements, and also deal structuring. We also prepare reports to assist with mediation or arbitration, and for us, forensic engagements, forensic investigation reports. Omar will go into quite a bit more detail with some of our experiences with victims of fraud.
So I'll use this to an opportunity to do our third poll, just to get an idea of whether any of you guys in the audience are in any of the situations that we mentioned. If you could be, maybe you're a business owner, or maybe you're maybe let's say in the next 6 months kind of timeline. If any of these apply to you, feel free to check it off, and then at least we'll know that we can follow up with you, or that we can, also you can reach out at any time just for a phone call. So I'll leave that up for maybe 20 seconds, and then we can move to the next. Okay, so there we go. So as you saw, we offer many different services, and that also includes quantification of losses as well as forensic investigations. Unfortunately, this is something that we do come across regularly, and it's more relevant now that people and businesses are in financial difficulty. Like the motivation, if somebody was, already thinking of doing something bad, this is going to accelerate it. And businesses, if they're in trouble, they're less likely to survive being victims of something like this. So we wanted to share with you what ends up happening when things get to the stage where we get involved. Okay, so typically we've been, the clients will ask us to investigate and quantify the amount of loss. And this is necessary because it's needed by either police or the insurance company or a court. And unfortunately, more often than not, in our experience, the victim does not recover their loss. So obviously, we want to design our business workflow so that there are checks and balances, there's internal controls that can prevent something from happening. So we want to limit that opportunity, but we usually get involved when it's too late. So at that stage, really your luck, how you fare depends on three things: whether the perpetrator still has, the funds or the money, or whoever has, maybe there's a breach of contract, that person is able to actually pay you and compensate you. Whether the other party has spent the money, if it's somebody who's stolen or committed fraud, whether they've spent that money on assets that actually retain the value or not, so you can still recover something. And lastly, whether insurance will cover your loss and your expenses. So we don't really control what the perpetrator does. The only thing we can control is our insurance. And so that's why we wanted to make a recommendation on that. If your business has employees that handle money or funds or have control over that, or if you have contractors dealing with that, we recommend that you have a discussion with your insurance provider and find out if you were the victim of theft or fraud, would they compensate you? Do you even have that coverage? And if so, how exactly do they define theft or fraud? Because you want to make sure that you don't end up in a, a legalese kind of word, again, where you don't qualify for how they define it. The other thing you want to know is what is the dollar amount of coverage, because you're typically not going to go to an insurance company until it's a significant amount, and that's when you won't deal with it yourself. You'll go to them for help. So you want to make sure you have sufficient coverage. And finally, if there is fraud, will your insurance company cover your costs for the accounting work, the legal work, the forensic work that goes into it? Having a loss quantification report is a necessary requirement for police. It's a necessary requirement for insurance companies and also for court. And that's because a judge wants to see, and the insurance companies and the police, they want to see that a financial expert has looked at the situation and they agree with your claim. They also, they've done some work to quantify a reliable conclusion. So, obviously it's an unfortunate situation, but it's better to be, the prep work at this stage can help, prevent losses later. I think that's the last item that we had. And so if you have any questions at all, even if you're not in one of these situations, you're just curious, or you had any questions about anything that we talked about today, feel free to reach out to us. So that's our team. We've got Jason Gibbons, he leads our team, and then myself and Michael, and then we have other staff. You can reach us by email, or you can just give us a call at the RLB office and ask for any one of us. There's a number there. And you can also just Google it and find her. And I wanted to end with some investment advice. And this is, I was going to say, this is just a joke. Don't go and invest in tennis balls. But I was actually Googling it last night, and it turns out the tennis ball industry is doing quite well. So it might be a good industry. Okay, so I'll hand it over to Mary, and we can open it up to discussion.
Thank you so much, Omar and Michael, for sharing your expertise today. We'll now open up to our question period. If anybody has any questions, feel free to include them in the chat box. All right, would the first step for any business be to have to update financial records, such as banks reconciled?
I think absolutely. We want to have, when we do a business valuation, we rely on your financial records. And if the records are not reliable, then it kind of brings into, we need to be able to, in some industry, there are some rules of thumb where you can, instead of selling your corporation, you can actually sell the assets of the business, and the assets might have an active market where you can figure out the value in other ways. But I would definitely, even not in a business valuation context, I would definitely recommend getting your monthly bank reconciliations. It's very important. It's a good preventative control to make sure that you're not leaking cash and everything makes sense.
Thanks, Omar. If anybody has any more questions, feel free to put them in that chat box there. Oh, we've got another one here. Have multiples been increasing or decreasing in 2020?
Did you want to take this, Michael, or?
As Omar mentioned in one of the slides, we're looking at each individual business on a case-by-case basis. There have been some businesses that have actually increased their revenue quite a bit, depending on what their product line is like, or what their services that they offer. So, in situations like that, their risk might actually be lower. And then there's other businesses where there's a lot of uncertainty around whether or not their customers are going to survive, or if their suppliers are going to make it. So we definitely look at a lot of different things. It's not a hard and fast rule. We'd have to look at the business that you're looking at in terms of to determine whether or not the multiple would have changed for that one. There's quite a bit of industry documentation on which industries have been affected more than others.
And if what Michael said, if you're in an industry which has not been hit bad, your multiple might go up because people are, people who would have otherwise invested in other industries that have now been hit hard, they need to put their money somewhere. So then they go more towards the safer industries, sort of like how, people invest in Canada because other parts of the world might be volatile. So foreign investors bring their money here. So just like that, if your industry or business is stable, its multiples could potentially have gone up.
We've got a question
Yes.
here. What is a multiple?
So a multiple is basically, when we value businesses, what we say is how much money does it make? So there's different ways of doing it, and a multiple may not come into play if you're, if it's a holding company or it's a growing company, a multiple may not be relevant. But in a steady business, the way we do it is we figure out how much money a business makes every year, and then we multiply that by what we call a multiple. And mathematically, that multiple takes into account all the risks associated with that business. And different industries have different multiples. Within an industry, different companies have different multiples. So that's what that is. And it's good to know what the multiples are in your industry, so you have an idea. You can quickly look at your income or your cash flow and get a very rough idea of what your business might be worth.
Like we've got too many other questions. Oh, one more. How do you find out that multiple?
So we use a lot of different resources to build a multiple. We use a method called the Ibbotson build-up method. And what it does is it takes into account all the different risks that would be associated with that specific company, any company really. So the most risk-free thing you can think of would probably be like a GIC, where you're putting in your money, you're going to get it back. If you put money into a private business, there's going to be more risk to that because you may or may not get it back. If you're buying a publicly traded company, they're really, really big. So, there's a little bit less risk there. But then there's also, company specific risks. So it's a bit of professional judgment when you're looking at that, depending on, is there longstanding customers? Is the company growing? Is it shrinking? Does the business owner have all the relationships? Can you transfer that? So we usually, it's a custom process that we would build a multiple for that company. And then we would also try and figure out what the optimal level of debt is for that type of company. So it's a bit of a process to come up with that. We can provide you with a little bit more information if you'd like.
Yeah, and also, in addition to just, kind of crunching the numbers and coming up with a multiple, we also we do look at other businesses in your industry, similar sized businesses. We have access to databases and publications, and we look at, okay, how similar businesses, how are they selling? What multiples are they selling for? And based on actual data, and then we use that as a sanity check on our analysis to make sure that we're in the ballpark.
Great, thanks, gentlemen. We've got another question here. What is the valuation method used for restaurants, and has this changed post-COVID?
That's a good question.
I looked at a restaurant recently within the last couple months, and they had a huge period of time, basically March, April, May, June, where they had no revenue or very minimal revenue due to either lockdown or reduced seating allowances. So we have to look at what the business is going to be doing after this. So if this is the new normal, and the business doesn't, maybe their customers aren't coming back, then we can't really look at historical financial statements anymore. We have to be looking at future projections, future budgets, things like that. But there are some restaurants where people are starting to go back out again, and maybe they were always in a good location, so they were less affected. And we think that things will return to normal for them. So again, it'll be probably a case by case basis where we have to assess whether or not they can survive.
Yeah, I think in the past, for restaurants, we probably it was an income-based valuation, like what's the historical earnings, but now it's all about projections, forecasting. What did the next 24 months look like? That's key. That's what banks are looking at as well. And just as we were talking about multiples before, a multiple is the opposite of the risk. So the higher the risk, the lower the multiple. The lower the risk of the business, the higher the multiple. And if you guys have any more questions, you can also, I think Mary will talk about that. She's going to send out contact information and other ways to get in touch with us. And we're always willing to just pick up the phone and answer some questions.
Thank you so much, gentlemen, for your time today. And thank you, all of you, for joining us. We will be sending a follow-up email tomorrow morning with a feedback survey. If you wouldn't mind taking 2 minutes to fill it out, it would be greatly appreciated, as we're always looking for ways to improve the services that we offer. You can find us online on Twitter, Facebook, and Instagram, also on our website, rlb.ca, for future webinars that we'll be offering. Thank you again, and have yourselves a wonderful day, everyone.